Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I've got Scott with me again today. He is, I guess, my homie. He's always coming on, sharing our opinions. We both kind of simultaneously were going back and forth on Twitter against somebody on Twitter, happens to be Mark McGuire. We had him on the channel. We have a big disagreement on what potentially is coming. I want to state my case. All right. So, I'll state it using data. It's not my opinion. And I'm gonna say a whole bunch of things in this clip that may be controversial to a lot of people. So I'm just gonna throw that out there. It may go in the face of what people think. And I'm not here to try to convince you necessarily that I'm right. That's not my goal. My goal is to convince you that you might think differently about the approach of solving problems or coming into investments. The reason this is important is because if you get this wrong, it can massively impact your investments. I'm talking like this is the driver of your investments. If you get this wrong, this is the difference between a 20 bagger and making nothing, or positioning in a way where everything goes against you, where you go down 50% when some other people are going up 50 times their money. I mean, literally 50 times. So first I'll step back and I'll describe the back and forth that we've had. So we were going back and forth, and his take for the most part is the Fed will increase rates and it will completely demolish the markets. I agree that it will demolish the tech stocks. Completely agree with that. I disagree that it will actually control inflation. And I disagree that they're able to basically cause a deflation like he's saying. So I just want to go over and say, how powerful is the Fed? To me, this is easy to see. You can't hike into slow growth. You will literally destroy the fragile system we have. This is why Ponzi Powell waited till too long to hike. Now people are going to pay for this mistake. February 2021, he should have started, I think he means increasing interest rates. He says they will kill inflation and take the stock market with it. Then they have an excuse to print way more Ponzi scheme than last time. Well, I'm going to go over some data that contradicts what he's saying. And what I think, my opinion is they can't stop inflation. Inflation comes from more loans into the system. They can slow it down, yes, but I don't know if they can stop it. The housing market is so out of balance with the demographic that's coming. And we've seen this in history many times. This isn't the one time. This is many times, all the times. Every single deflation had a housing market crash before it. All the big deflations. And I'll show you all the deflations over the past timeframes, and I'll tell you and describe to you the situations in the housing market that caused those situations. What I'm looking for and what I'm trying to show you guys is you need to look for the leading factors. What is driving inflation? What is driving deflation? What is the cause of these problems? Now, I don't know if I have everything 100% right, but I do think that I have a lot of it right. So let's dive in to, hold on one second. Neela. I had some kids show up there. So I'm going to go take a big picture view. Okay. So let's look at the deflations in history. I've got an 80-year look. We've had a deflation in the late 40s, early 50s, where it actually went negative and had a negative inflation rate, which is deflation. That's credit destruction. We had a small deflation in 2009 where we went negative. And we're not talking about the big boy hit in the 1920s that went massively negative, and in the 1930s. So those are two other areas. But looking at the 80-year period where I have the data, we would suspect that, in my opinion, the demographics would decline in 1950. Subtract 30 years, because that's in home buying years, the first time home buyers, subtract 30 years. So people born in demographics in 1920 would cause this deflation. So by about 1920, we should see a decline in the demographics. So let's see what we have for the decline of the demographics. Oh my goodness, look, 1920, there was a decline in the demographics. You had 30 years, that's 1950 in home buying years. Now let's just not go back. Let's just look at the demographics of the percent change of US population. The baby boomers in 1970s had an increasing demographic with a demographic pullback in the middle of the 1940s. Add 30 years to it, what do you get? It's in the mid 1970s, we should get a pullback in the housing market and in inflation. So let's go back to the other graph and take a look. What do we have here? In the mid 1970s, 74 to 76, in the mid 1970s, we had a pullback in inflation. No way we could be forecasting with demographics the inflation rate and have a 30-year lead time to that move. Now, what do you think is going to happen? And we can see the M2 money supply react quite immediately to that demographic. The inflation rates lag behind it by 12 to 24 months. What do you think this large M2 money supply gap up is going to do to inflation? It's going to be quite dramatic. And the red line is starting to follow that line. Now, could this inflation rate slow down some because we have a decline in it? Yes, it could slow down. We could see disinflation for a short period of time. But guess what? The demographic is driving some of this here. And the stimulus money would be the disinflation. We would go to a lower level of inflation to where the demographic can support that inflation level. This is what's coming. Add 30 years to 1990, and what do you get? 2020. And what do you get when you add 20 years to 2025, 2026? You get 2025, 2026 if you add 30 years to 1995, 1996. And it depends on the first time home buying years, but the demographic will run out roughly at that time frame. That is what we've seen in history. Now, has the Federal Reserve ever in history basically turned this demographic into a deflation? Has that ever happened in history? In my opinion, no, it's never happened. This has always been driven by the demographic. And what does the demographic drive? It drives a couple of things. It drives spending habits because of the age group that they're in and the babies that they have and all the spending habits. And it drives the inflation from the housing starts. So if I were to grab a housing starts, you'd see inflation coming during these periods where homes were built in greater and greater quantities. The largest boom that we've had in terms of inflation and its duration was in the 40s and 50s, and it maintained a pretty high level all the way to the 70s and 80s because of the demographic. The demographic went up. If you add 30 years to this, so 1950 is roughly the bottom here, and it was a big boom. We came back in the demographic. It was low in this time frame, and then we boomed again. The demographics are driving these behaviors and moves. They're driving the spending habits. They're driving the need for real estate. They're driving the amount of housing starts that are needed. They're putting the pressures in the market, and they're pricing the assets and interest rates through the demographic. So when he says that the Federal Reserve is going to cause a deflation, and he says it because what I said is he goes, but we disagree. The timing is different. He thinks it's going to happen immediately. I think it's out in the future a ways. That's the big difference. And remember, the difference could be 50 baggers in your portfolio. That's what we're arguing here. We're arguing 20 baggers, 10 baggers, 15 baggers. That's what we're arguing. And also, interest rates follow the price of oil. And I'm going to go into some information about oil. But it says every time unemployment hits a low, it's within months, it starts climbing. Unemployment doesn't matter. We have a demographic that's far larger. The unemployment in the 1970s, when we had that housing boom and all that inflation, unemployment went up. It did not go down. So the unemployment should be taken off the table. And it went up quite a bit. It wasn't a flat number. It was increasing. And he thinks that the Fed is very powerful, and a lot of people believe this. I don't think they have as much control as what most other people think. They think that they raise rates, everything's just going to blow up. The stock market might blow up. I agree with that, and same with bonds. I don't think the inflation will necessarily go to a deflation. They have to kill the housing market. The housing market doesn't have any inventory. Every single time that we've had these deflationary crashes, every single one that you see in history where this inflation rate really gets hit was from demographics and overbuilding. Almost every time. Almost. I don't say every time, but almost every time. That overbuilding happens at the peaks here where they overbuild, and then the inflation comes back down and the M2 money supply leads it. So you have an 18-month to 2-year heads up of that window. If the M2 money supply isn't going into deflationary, coming down negative, and this last time it didn't do it because they stimulated the economy, but there's no way to get that money into the economy through loans. Here we do it. We can have loans. It's demographic driven. We are coming back down. It will have a little bit of disinflation, but I don't think it's going to go to a deflation. The extent that he's arguing, I think, is incorrect. And the window of opportunity here, even if it's 1 or 2 years out, makes a big deal, because that could be the entire commodities bull market stuck in that window. The whole thing. So it's very much important to get this right. Now, if I look at my profile, I'm just going to go through some things here real quick. We don't have the oil prices, guys. We are going to go into a recession, and it could be bad, but it's going to be driven by commodities. And the big boom, what this is going to happen, in my opinion, is we are going to take money out of all of this frivolous spending tech garbage, and we are going to have to deploy it all to commodities if we want more commodities. This money is going to all rotate there. Why? Because we have major shortages coming. Major, like as in we could have gas rationing maybe even sometime this year, if you look at some of the inventory levels. This here is the inventory deficit. And it says Michelangelo himself could not have painted a picture of an energy crisis better than this. And this is this gigantic deficit against the 4-year average. We are really drawing it down. We are hitting huge oil and product draws, even bigger when considering the 5 million barrels of oil from the SPR. We had a crude oil draw of 3.4 million plus the 5 million from the SPR. Cushing was down, gasoline's down. We are drawing down inventories. Does this look like a weak market in terms of demand for oil? Is this recession blowing out the oil demand? Doesn't look like it to me. We are going to need more copper in the next 20 years than we have used in the past 130 years. Does that look like it's a bearish sentiment? Do you think copper prices are going to go up in the next 20 years? Probably very much so. I'll keep moving down. We've got the CRB to SPX ratio here. Does that look bearish? Sure doesn't look bearish to me. That doesn't, if a recession was coming, you know what it would look like? It would be diving down massively and breaking all trends. All bets would be off. Commodities would not be the play if this is going to be some huge recessionary, deflationary collapse. Move on down. U.S. gasoline storage. We are at the lowest level for this time of year over the past 5 years. In fact, I was hearing people say that this was probably the lowest level ever in this time of, in compared to demand in this time of year. So what do you think is going to happen when the summer driving months come up and all these airplanes start flying? You think this is just going to go, oh yeah, we're just going to go straight higher? The demand for, and I know this is US gasoline, but the demand for oil products is going to go up substantially. And this is with China in lockdown. Imagine if China comes out of lockdown. Oh my goodness. These numbers are absolutely horrible. I'm going to keep going down. OPEC ministers are coming up and saying no increase of supplies coming online. They're also saying that this is the worst they've ever seen it. If this is the worst they've ever seen, do you think this looks like a recession? It could be. In stocks, we could see a major recession because of oil. And I think oil is completely mispriced at the levels that it's at. And then, I mean, that's where I'll stop it there. But we have an energy crisis basically in all energy sectors: coal, natural gas and oil, and I think nuclear is going to follow next. And it's going to spread across all energy because that's what we're short. That's the root cause of this problem. And the demographic that's coming up, which is the denominator or the value of the dollar, is a larger demographic that's coming up, which is going to, I think, continue to apply pressure from the inflationary front through housing starts. So that's what I've got there. We've got Scott with me. I'd like to get his opinion too. That's kind of my case on it because I wanted to, get my rant out, or not really a rant, but my case on it. But what do you think, Scott? What's your opinion, and how are you looking at this?
Yes, I think the key word is stagflation, right? Because just because the unemployment rate goes up, it doesn't mean that the resources sector needs to come down as well. So back in the 1970s, for example, this is unemployment rate here. Dow Jones at the top, unemployment rate in the middle, and then you've got the used oil, which is the oil price. So what you see here is unemployment shot up from, say, for example, 3.3%-ish, 3.4% back in 1969 to 6.1%. And oil price shot up during the same time. So if you look at the oil price down here, it went from like $3 to $3.50. And then if you go down a little bit further, you've got unemployment, which shot up again between 1974 to 1975 from 4.7% to 9%. And oil prices during that time went from $5 to $13. So, I mean, and look at it rising, right? And it will just continue to rise. So just because unemployment rate goes up, it doesn't mean everything needs to come down crashing. And that's what we mean when we talk about stagflation. It's a combination of falling stock prices potentially because of an economic slowdown. And then against that, you've got rising commodity prices, which is what we're expecting. So that's one measure. And here's a proof of that. I don't know. So obviously, there are heaps of commodities that have sold down, right? So you can talk about nickel, you can talk about iron ore, you can talk about, copper, but those commodities, don't forget, they've run hard over the last couple of months, right? So if I just go back to nickel, for example, if you look at this chart, this is not a bearish chart. It's just taking a rest. If you look at the nickel price, we've had a parabolic run. It's due for a rest. You can't say this sold off because of the general equities market. It could have just sold off because it was just time for a pullback. It's a normal market reaction, right? So after a huge run up, and I like talking about the 5 to 8 months rule. So you had 1, 2, 3, 4, 5, 6, 7 months of continuous run up, which means technically, just looking at the charts, it was due for a pullback. So this is, for me, totally a normal market reaction. And so also what you see here, or what you've seen recently, is a rotation happen. So we might have not benefited in the uranium space yet, but I think it will follow very soon. And we've got IXIC, which is NASDAQ at the top. So this is when, the NASDAQ started its decline. But look at XOM. So this is ExxonMobil. It's continued to rise. This is showing us that the money is flowing out of the general equity sector into the big names. So obviously the smart money starts positioning themselves in the large sectors first, large names first, because of the liquidity that it provides. And so the money, you can see right here that it's just following. The money is rotating out of general equities into your big names, big tech names. So let me just change this, so you can see more clearly what I mean.
And
so look at that.
The reason you're sticking to the large names is because the big institutional buyers with lots of money has to buy the large names. And so that what we're gauging is the rotation of money by institutional or large institutions with a lot of money. That's why we're using the big names.
Exactly right. And typically what happens, I've talked about this many times, but typically what happens is the big names lead and the smaller names tend to play a catch up. So it applies to commodities as well, I think. So gold leads and silver plays a catch up. You see that a lot of the time. So if I just go back to the gold chart, for example. So I'll just show you what I mean. And this is a very typical behavior that you see across all commodities complex. So if I just put in gold chart here at the top, And silver, what I mean is silver didn't do anything. While gold was running up, silver didn't do anything. And then at the last minutes, near the final stages of the last leg up, silver just did a massive catch up. So all that period here, what I mean is all this period here where gold had a massive run up, silver did nothing. That was just a consolidation for silver. So this is what happens in commodities as well. So just as the smaller caps, if you're talking about companies, just as the smaller caps tend to play catch up to the bigger caps, and bigger caps always lead. It's the same with, I believe, the commodities as well. So gold leads, typically leads, silver and platinum follows. I think oil leads, natural gas, and then uranium will follow. So that's kind of the logic. So unfortunately, if you're in some of the smaller uranium miners, they might be the last ones to follow. But you know, it could just mean that they play a bigger catch up than the rest in the sector as well. So I feel like we're seeing this. Like we're not seeing rotation out of commodities. We're not seeing the selling pressure in commodities, specifically in the energy sector, because this type of environment is very favorable for energy sector, right? Which is why Andy is like so big on natural gas and oil, because he knows that this environment, this stagflation environment, is very beneficial for the energy sector. Because what do we need as human beings? We need energy. That's kind of like the essentials for sustaining our lives, right? Because without energy, we can't survive. And so what it will mean is, it doesn't mean that because people are becoming a little bit poorer, because their disposable income's down, the real disposable income's coming down, it means that they might reduce their spending on tech. So they might not go out and buy an iPhone, for example, but they still need to heat themselves. They still need to travel. And the lives are only just starting to normalize. So what I don't understand is people are calling for demand destruction when we're coming out of this lockdown across the world. Like China is just coming out of lockdown, for example. Australia has just come out of lockdown. The air travel is just opening up. And air travel forms a huge part of the overall energy spend, like oil consumption. Cars are the biggest consumption, the biggest factor that contribute to consumption of oil. And the roads are just getting busy. So when we talk about demand destruction, yes, I agree that consumer goods, for example, as I said, iPhones and some things that you don't really necessarily need in your lives, yes, they might suffer a bit of demand destruction. But when you talk about the essentials of our lives, like energy, food, people are just going to be spending more money on those things. And that's what the history shows. When I talk about, the unemployment rate shooting up in the 1970s, for example, and oil price shooting up at the same time while general equities are doing nothing, that's exactly the definition of stagflation that Andy and I expect to see, given the underlying fundamentals across the economy.
Yeah, and when this stuff breaks apart, when we have a decline in the overall stock market, it could tug us lower, and it has been. What it is we've got a lot of leverage in the system, and when people go to deleverage, they sell indiscriminately. And the way that I view that is opportunity. That's an opportunity if our good stuff gets dragged down with the bad, and you buy it. Now, why would I lose a position off of that? Why would I sell out of my position? Because we don't know the effect that may necessarily have on the commodity market. Sometimes it'll deleverage, sometimes it won't. There'll be a decoupling period, and it'll decouple and run. Do you want to be left out? Not this guy, not me. I'm not going to be left out. There's no way I'm going to miss this commodity bull market, guys. Like, this is going to be very, very, very violent and big, I think, in the energy markets. There is something very wrong in the energy markets with the inventories and the gasoline inventories being that low. And we're coming right into a summer season. And they are scared out of their wits, because they're like, release SPR, was it the EIA or whatever, IEA, release their strategic reserves. It's like they're releasing this stuff, trying to hold it down. There's no way they're going to be successful at doing this. And if China comes out of lockdowns, if we start traveling around, I mean, this is going to be like, I'm getting scared that we're going to get shortages. Like, they're going to have to start rationing stuff potentially if it gets that bad, if pricing isn't the mechanism that'll slow it down. I don't know what will, but there are shortages around the world that countries are experiencing right now. and it could come and spread, around the world a little bit more than what it already has. So, I mean, we'll find out. But it is a huge deal to get this right, because if you get scared out because of the market, you lose your position. This isn't coming back again. If you lose it, you are out. And if you're out and it does a 20 bagger and you've got, 10 grand turns into $200,000 for you, that's a big deal. That is a
And
big
if you've
deal.
got a couple of them, if you've got a couple of them, yeah, it could be millions.
Could be, well,
Even-
I mean,
even
that's
with
what
the-
we were saying earlier. We
Yeah.
could have been, if I knew what I was doing and I could play it right like I could now, I'd be a multi-millionaire. Well, I wasn't in the beginning. I could have if I could invest when I was in college, but I'd probably be a multi-millionaire by the mid 2000s. I would have been 24 years old or 25, 26, somewhere in that range. Multi-millionaire in his 20s. I mean,
Yep,
how many
exactly
people
right.
do you know that are like that? I mean, maybe some crypto people, but because of the bubble.
Yeah,
do
and
we
this is
got?
what Andy's talking about, right? Because you've got the Nasdaq Composite deposit, which crashed, absolutely crashed. So you don't know if there's going to be a spillover. I still believe, because we're not going to have a housing. So for me, the biggest differentiator between the environment right now and the environment back in 2008. So let's go to 2008 when everything absolutely crashed, right? The biggest differentiator right now in 2008 is, in 2008, there was that housing bubble. Andy loves using housing as a driver economy. And the reason for that is because 60 to 70% of the commercial banks' books are made up of mortgages, which means if housing crashes, the whole banking system collapses. It's not the same for the technology sector. And this is the proof of that. So back in 2000s, for example, when NASDAQ crashed, we didn't see a crash in CCJ. CCJ exactly the opposite, and we started going up. So this is a NASDAQ crash where NASDAQ absolutely got hammered, and you've had really, really large caps here as well. So for example, in 2000s, Yahoo traded, I think, at a valuation that was equal to the valuation of all New Zealand stocks combined, right? So we had a massive bubble. We had massive market caps back then as well. And NASDAQ crashed 78%, right? 78%. But what did we see in CCJ? CCJ didn't crash. This is the bulk of the downturn. CCJ didn't crash. And this is what I mean when we talk about, would I gamble and say, okay, the contagion is going to be likely be, like what we saw back in 2008. I wouldn't gamble on that at all, because we didn't see that in 2000s. We're not talking about a housing crash here. We're talking about a tech sector crash, which in 2000 showed us that there is no contagion from tech. And we're not talking about relative value of the tech companies back then were huge as well, right? Because if you do a measure, if you look at the tech sector now compared to back in 2000s, we haven't really gone up that much from the 2000s bubble. And obviously the GDP and everything else was smaller back then as well. So in terms of its relative value compared to the other general equity sector, I would say it's even lower. So let's just go IXIC, DJI, for example, right? Yeah, so it was pretty much the same. There was no contagion there. So tech sector can crash now. And if 2000 was to repeat, we're not going to see a contagion effect like we saw in 2008, because tech sector is relatively small. They're not leveraged like the mortgages are, like the housing sector is. And I don't know. I don't think I can comfortably say, okay, let's say NASDAQ crashes 70%. I don't think I'd be comfortable even calling for a crash and everything else, because maybe we don't see it like in 2000s.
Yeah, a lot of people will say, oh, the housing market's in a bubble. The problem is, every single time we've had a bubble in housing, we've had high inventory, like 8 to 10 months worth. We are at record low inventories. I mean, they're gonna have to go up for a while. And it's the important aspect here isn't the fact that the housing market, it's not the fact that I'm saying that it's going to necessarily go way up. It's the fact that we have to have that inventory rebuild before we can crash it. So what that means is it's going to take a long time. It's not going to take 6 months. it's going to take probably 2 years. It took many years for all those bad loans to stack up in the mid 2000s to get to a point where it was like blowout crash. So in 05 to 06, 06 it started going up, 07 it was going up. That's when it got to critical levels. Then in 08 it had the crash. Could someone see that crash? Yes. I could see it based off of the data that we're looking at. Now here's the thing. Can I see that a crash is coming from real estate? No, there's no crash coming from real estate. I can say that with 100% confidence. Why? We don't have enough inventory. You cannot crash without inventory. The demand is strong, the inventory is thin, and we are going to have to, it's going to take time to build back that inventory. So I don't think that we're in crash territory from the housing market. Now, could the NASDAQ pull back and could bonds pull back? Very much so. And could interest rates continue to go higher? Yes. That's what I'm banking on. That's going to cause money to rotate and find another house. And then they're going to all FOMO in to energy. They're going to FOMO into energy. They're going to FOMO into precious metals because of the dollar. Now, the dollar has been weaker the past week. I don't know if that's going to continue. We're going to have to monitor it. And people who are looking at data, don't use a day or two or a week or two to support an argument. That isn't a long enough time frame. You need to use probably a few months, like 6 months or 5 months or something. You can't use a week or two and be like, it's crashing, therefore I'm right. Like what that is telling me is that you haven't been in the markets for very long. It's telling you, or it's telling me and everyone that you're basically a new investor, like a newbie. Like that's the way that I view it. Because what happens is as you become more experienced and as you become, as you invest throughout the years, at least this was true for me, and maybe it's for others, you take longer and longer time horizons, and then you start playing the markets and their entire trends. Hardly anyone who is a billionaire or someone who has a lot of money has played it playing the small little movements in the market. They don't do that. They play the big trend. They play the 10-year move. They play the 20-year move. They say, hey, look, we have massive inflation for many years. I'm going to start investing in precious metals for the next 10, 20 years. And then they get this big boom as a demographic comes through. And they may or may not know that the demographics are driving it. They may just get lucky and they feel it. But the demographics is what I found is driving these things. We have a larger demographic coming for 3, 4, 5 more years. I don't think the Federal Reserve can't stop that. They can't raise interest rates and build homes at the same time. They don't just go poof, here's a whole bunch of homes, your inventory repletes back up, basically comes back to normal levels or high levels, and then we just deflationary crash it in 6 months. There's no way. I just do not believe that that is possible. We would have to have a copious amount of demand get completely destroyed, and on top of it, we'd have to have a bunch of people selling their houses all at the same time. And maybe it will slow down. I agree with that. We will slow down. We will get inventories that come back maybe to more normal levels. I just don't think they can do it that fast. That's my take. And if it can't do it that fast, you could have a literal bull market of commodities just massively run in the next 2 years and be completely missing the entire bull market of the big meat of the move from a liquidity driven event. And I'm not talking like little moves here. We're talking it could be the big meat of it. 10 baggers, 20 baggers, like things just go vertical with these small exploration companies in uranium and some of these other ones and maybe precious metals. But guess what? Those are also markets telling us that we're not at that time frame. Because if we're in the middle of this bull market, how come gold's not going up? How come platinum hasn't gone up yet? How come silver hasn't gone up? Where are all some of these other laggards in the bull market? If they're not going up and we are in a bull market, which we see in all these commodities, the ratios, we're not as far along as what most people think, I don't think. I think we're still early because I haven't seen those move yet. So I'm taking data from the market. I'm looking across and saying the demographics out there, it's still got years to go. I'm not seeing the end of cycle moves yet. I haven't seen them yet. So we can't be at end of cycle because what he's doing is he's saying that stagflation comes before a deflation. He is right that inflation, high inflationary periods come right before the crash. Problem is, you got to look at the housing market and the demographic. And if your demographic and housing market doesn't support that next event, that next deflation recession type move, he's got it wrong. Because the driver isn't there for it to happen. It's going in the opposite direction. So, I mean, I know again, guys, this is my opinion. I know he's not here to defend himself, and I'm not trying to make it. I'm just making my case. I don't think that that's right, because a deflation comes from the housing market crashing. And that's where he's got me kind of bent out of there, bent up a little bit. And the timing. He says very short term that he thinks that, and I agree that the NASDAQ and S&P 500 will probably go down and will probably go into recession. What I disagree with is that the commodity sector is the sector that's going to get hit too. That's my main disagreement. So I agree that a recession's coming. I agree that those stocks are going to go down. I disagree that the commodity sector, and everyone else is telling me that they go down too, but they don't. In the 2000s, it didn't. And that's the same exact to the T, demographic to demographic, the increase of rate, it's very similar. This time being bigger, the demographic is much larger than it was in the 2000 to 2008 move. It's much bigger and much longer. So the imbalances are greater in the system. If the imbalances are greater in the system, and we can see that through the inventory level of the housing market, everything I'm saying has full alignment. I'm not trying to take and cherry pick things. If we had the biggest demographic, would we see the highest home price increases in the United States ever? Yes, we would. So check, we just did. We just saw that. So then they're raising interest rates saying, crap, we need to try to slow this thing down. The demographic's piling in still. That pressure's still there. We should see rent prices go up if we have a shortage of homes. Check, rent prices are going ballistic. So everything, all the data is supporting this argument. The problem is the counter argument doesn't have any data. They're just giving opinions. What do you think the home buyer sentiment would be in the biggest shortage of housing ever? It'd be really low, because guess what? I can't buy a house. My sentiment's horrible. I don't want to rent and have a 50% increase in my rent from a year over year. Do you think my sentiment's going to be high? I'd be like, no, this is horrible. I go to buy a house, and the 5 homes that I bid on, I got outbid every single time. What do you think my sentiment's going to be? It's going to be crappy. I'm going to be like, I don't like this. I don't want to go and buy a house. And a lot of people, the sentiment's so low that they just say, I'm not going to buy a house. I can't get one. But there's so many people in that same camp. The sentiment doesn't matter. The sentiment is a reflection of how screwed up the market is. Yep. So how could you sit back and say, oh, I feel great. I can't buy a house and the prices are going up 20% a year. You think they're going to feel great about that? No, they're going to be like, this is horrible. My sentiment is horrible. The home builders, of course, their sentiment's going to be super high. Why? Because they're raking in money. They're like, we're selling every house 18 months out. Will that slow down? Yes, it will slow down at some point. I don't know that point. I don't think we're within 2 years of a housing crash. I don't think it's within 2 years. I think it's out there. It's probably 2026, 2027, 2028, 2030, somewhere out in that range. Why? Depends on how fast we can build it. Depends what the demographic can afford and how fast they can get in these homes. That's all it is.
Yeah.
So I know I'm kind of ranting here a little bit.
No, it's good. But when you look at data like consumer sentiment, for example, you just need to go back to history and see whether it was an accurate predictive, crashes as well. So if you go back to the 3 times that consumer sentiment crashed, so back in 1990, when was this? 2008 and 2012. What you'll see is that it's only been kind of like the leading indicator in 2008. Other times it was mega bullish because the consumer sentiment was like super low and the economy is just about to run. So it's just not an accurate indicator. Like just because the consumers feel negative about the economy, it doesn't mean that exactly what you said, Andy. Like they might be feeling negative because the inflation is going up, because the oil prices are going up, because the housing prices are going up. It doesn't mean those prices need to come down to meet the consumer sentiment. So you just need to look at data and see how accurate they've been in the past in predicting recessions. So
yeah, and I think a bubble is coming in housing. It's just not now. It's 5 years out or 6 years out or 7 years out. And the bottom is 5 years from the top. If you want to know the cycle, it's 5 years after that top. So if it tops out in 2026 or 2027, add 5 years, that's the bottom of the market, roughly speaking. So if we peak in 2027, maybe 2032 or so. Do you want to wait that long to buy a house? That's up to you. And that's out there ways. That's 10 years out. It's a decade out. And that's just roughly the cycle. And the cycle could be off a year or two. You know, maybe it's 2025 that we peak. But that's still 3 years out, that a peak. And then we have 2 years above, you know, maybe around it where it starts to really start to crash. So that might be 2027 for the crash, or 2026 at the from a housing market related crash and a deflationary type bust. Could the market slow down with increasing interest rates? Yes, it could slow down, but I don't think it'll crash. We need to build the inventory back up. That's my take on it. So be careful who you listen to. Be careful what your thoughts are, and make sure you back test it off of other historical means, and then look for similarities and differences. Guys, we are coming into an energy crisis right now. We are in it. And we've got stock prices of oil companies that are ridiculously low in relationship to the price of oil. And I think the price of oil is ridiculously low. I mean, in comparison to the inventory levels. We are continuing to draw down. And I'm like, prices got to go up. We got to turn this around. It's momentum going down. This isn't like we're leveling off and slowly coming. It's like a good sharp drop in a spot that we're supposed to be building inventories. This is ludicrous to me. Like, something bad's coming, guys. I mean, that's my take in the energy sector. We could really see some problems with food. I'm getting I am a little bit scared with all of this, and you know, positioning for it. I mean, good thing I've got a lot of physical precious metals and all that other stuff, because I mean, if we have, I mean, think of this type of scenario, and I'm not trying to be a doom and gloomer, but what if we have to ration fuel, you know, a good amount? Do you think that this just-in-time delivery system is going to do well for these companies? If we're rationing fuel, they're going to eat it. They're going to be in a recession and they're going to eat it. But guess where all that money has to go? It's got to divert towards energy. That's how you fix the problem. The money goes to where the problems exist. If a problem for you is that you can't afford to heat your house, there's an opportunity because the price is high. And then all resources, smart people divert effort to solve the problem because money's involved. That is the free market. So you have to ask the question, what is causing this recession? What is the drivers? What is the causes? What does the demographics look like? What is the real estate market? If the liquidity continues to come into the system, that will slow down at some point, but money's got to divert into commodities because that's what's needed. All of this junk that's not needed is going to come rolling over and say, I need to eat. I need to go and have housing over my head. I need energy to heat the house. I need X, Y, Z. All the money's going to divert. You're going to see money literally rotate out of those sectors into these sectors based off supply-demand fundamentals. And then the liquidity into the system will also be there. So that's like that's basically the perfect ingredient for the largest commodity boom that you can think of. I can't think of another way. You have to have the demographics.
We're seeing signs of energy crisis everywhere right now, right? So
everywhere.
why do you think the Japanese are restarting their nuclear fleets? Same as
Yes.
Korea. Why do you think they are like promoting nuclear fleets as well? Same as China. They are going all nuclear. Like it's because there's evidently, obviously there's the ESG issue as well, but it's evident that we've got energy crisis. They can't get secure supply of oil and gas and coal. So they need to look for other means. It's like, I mean,
here's my other thing on it. What is the likelihood of renewables and wind, you know, the wind turbines and the solar and EVs? What's the likelihood of those actually being adopted in mass in a short time frame with a massive energy crisis going on? I think the likelihood is literally very low. They cannot adopt these in the time frames that they want. Do you think they're just going to start putting up all these what is it, the big towers with all the transmission lines? You think they're just going to be popping those things up everywhere while they mine out gigantic holes in the ground, moving earth all over the place while people are starving, and energy prices are up at like $10 a gallon? And maybe I'm exaggerating. Maybe it gets to $5 or $7. I don't know what the pricing is going to be. But do you think that world can exist simultaneously under an energy crisis scenario? I don't know. I don't know if it can. But I can tell you this. What if you've got nuclear power plants already built that people have decommissioned. And I don't know how hard they are to recommission, but they decommissioned them and they're sitting there idle. What do you think people are going to do? They're going to say, bring those back online immediately. They're going to vote people in that are going to bring those back online. And they're going to start running these things back up. Why? Because we have an energy shortage. Get them running. I don't care what it is. And then what's going to happen for the demand of uranium? Boom.
That's why
It's going to go boom because there's not enough. And then people will be fighting for that. All energy sources are game at this point. And in that type of world, you may even have problems with currencies. You may have problems with currencies. Why do you think I thought this through? Physical metals, currency problem. What if you have riots? What if things go down? What if the market has problems? Like there's that possibility, like that we could go to that extent. I don't know if we will, but there's countries going to that extent. If you find it in a couple of countries, what makes you think that you're isolated from it? So it's like prepare, a part of your portfolio for this type of scenario. Prepare your portfolio if energy were to go up. I have energy stocks and energy service stocks. Where do you think the money's going to flow? And what if their decision points are, hey, you know what? We're gonna drill like heck. We are going to drill like no other. What do you think the energy service companies? You think they're going to make some money doing that? How do you think I'm positioned? Energy service, energy, uranium. I'm like all these things, and then I've got precious metals and royalty companies because they've got that insulation from the energy costs. Like this is a pretty well thought out portfolio. And if you guys are interested, check out my website below, the Platinum membership, if you want to know how I'm positioned. You can see all my positions. I'm just throwing that in there. But like I thought this through. This wasn't like I just stumbled across it and all of a sudden, like I've been an energy shortage guy from the beginning. You can hear my old videos, listen to them. I'm still in some of the mining companies as well, just not as heavily. And I still have some juniors to swing for the fences in case something happens. But I don't know. I still think I don't know how. There's no way that I could not be positioned for this energy crisis and be afraid because of recession. That's just me. There's no possible way that I could be shaken out of this. Knowing what I know, looking at the inventories that we just looked at together at the beginning of this thing, knowing the demographics, knowing all that stuff, I have to be in it. What about you, Scott?
Same with me.
I mean,
same with me. It's the writings on the wall, right? It's just so obvious that there's an energy crisis and it's not going to resolve itself anytime soon. Like for me, it's like what's so evident is like if you look at all the data from Fred, like road miles are going up, your airplane miles are going up, your shipping miles are going up, like everything's like going up, right? So like consumption of energy isn't coming down anytime soon. Like you can't just assume just because we're going to be buying less iPhones, it doesn't mean those energy drivers, the consumption of energy drivers are going to come down, because they're not. They're going up right now. The world is normalizing. People need to see that the world is normalizing from COVID. So we had no activity in terms of roads. Well, little activity. We didn't have airplanes flying around. We didn't have like shipping's, that was down for a period as well. All those things are starting to normalize. Your key drivers of consumption of oil, gas, coal are all going up. So at a time when the supply is dwindling. So yeah, I mean, you've got to think about the overall economy separate to the energy consumption. It's different.
And one thing I do want to say is I don't want to see an energy spike. I want this to go up kind of normal. If you see a huge energy spike, it will cause problems. We will see dislocations. We could see a big recession. We could see the demand for these energy products go down as we just go ballistic. Now, I don't know what the top is. I don't know where that is. They could say demand destruction starts at 120. They'll say something on the lines of that, or 130 or something like that. But my question is, what do you have to what if you delay the demand destruction? What if you're releasing strategic petroleum reserves trying to hold the price down? But what happens if the gap gets larger and larger and then you withdraw that strategic petroleum reserve? Now your gap could be 5 or 10%. How do you have to kill 5 or 10% overnight? Are you going to see $250 oil, $300 oil? I don't want that, but I feel like we're just walking into this crisis and they're releasing all these reserves. I'm like, what happens if you reverse those reserves and they start drawing and filling them back up? I mean, what do we have to kill? We have to kill the strategic petroleum reserve refilling that demand. I mean, think about that for a second. If everybody starts to fill these back up, I mean, what if we get into a serious crisis? And I don't know. I don't have the answer, guys. I'm not saying that I know the future. I'm just posing questions and posing problems that we could potentially face in the future. And I'm positioned for it. That's what I am. I don't think there's much downside. I think it's a bunch of upside. So that's my viewpoint. And I think uranium's a good bet too, because it's also an energy. And what we're going to see is it's going to start in certain areas. It'll spread those areas out. And then next it'll spread to different sectors of energy. Then it will spread to other tertiary sectors, which is metals and food and all these other areas that are tertiary users of energy. And what's going to happen is if energy prices go rocketing, these companies are going to get in these weird situations where they can't afford to make whatever they make. They'll be like, costs too much for my input cost for energy to make fertilizer. And then over there, they'll say it costs too much for me to buy fertilizer, so I can't make food. And then everyone else will say it costs too much for me to buy food. I'm going to go riot. And then, it goes in that circle. And I'm like, man, that's not good. But I'm just kind of saying that it's a domino effect once things start hitting. And that's already hit in the other part of the world. What makes you think it's not going to come to the United States or somewhere else? I think it's a high likelihood, and we'll see what the prices are. I don't know exactly what they'll get to. I don't know what it's going to look like, and I don't know the path. But I can tell you this, I think it's looking pretty likely. I just think it's looking likely, and it's going to probably be this summer is my inclination of looking at the data and looking at the demand and what they're trying to do to hold it down. So I think we have a big problem. And I know that Buffett knows it. He's been buying the heck out of, Chevron and Oxy and all these other oil companies. He even sees it. He's like, oh my God, look what's coming. He's like buying everything he can. That's what I'm doing. I'm buying everything I can. I'll take uranium. I'll take this, uranium enrichment company. I'll take this other one. I'll keep adding in. Why? Because we have to. We got to do something. We got to put something in place. I don't know. That's my take. I know I'm kind of rambling on a little bit, but you have anything else to add, Scott?
I think uranium is just going to go nuts. Like, I mean, obviously it hasn't caught up yet, but I think what's going to happen is obviously with the oil and gas companies, now all the big funds are going into it, right? Like Warren Buffett and big, a couple of really big funds are going into the oil companies right now. But I think what's going to happen is, I think you heard of the story around Benjamin just yesterday buying up rare earth companies. So, Energy Fields also bought more rare earth plays as well, like tenements. So I think uranium players, like some of the bigger uranium players, are buying up rare earth because they see that as like the strategic acquisition for what's coming down the road. But what's going to happen? This is something that Shovel Stocks, Andreas, do you know Shovel Stocks on Twitter?
Mm-hmm. Yep.
This is what he's been saying for a while as well. Like your oil and gas company is going to be so like cash rich down the road, and they are reeling in cash right now, right? What are they going to do, right? Because they always talk about ESG stuff. They always talk about their pathway to cleaner energy. So what do you think they're going to do when they have like billions just sitting in cash? They don't know what to do with it other than share buybacks and dividends. What are they going to do? They're going to be looking for solutions where they can go, yep, now we're going to divert away from dirty oil, coal, and gas, and we're gonna be investing in uranium. That's potentially what's coming. And imagine the flood of money then. Like maybe this will be a time where there's a massive energy transition because they finally realize that oil and gas isn't really a sustainable for electricity generation. So maybe that's kind of the kind of fund flow that we can expect to see going forward. And what was really interesting about Benjamin's acquisition yesterday was, I think it was a joint, it was like some kind of partnership with an oil and gas company that had a strategic plans to acquire, make acquisitions and invest in clean energy. So I think we're seeing like glimpses of that. This is not a recommendation to buy Benjamin or anything like that. And it's not financial advice, but I think everything out there is pointing towards energy crisis and funds flowing into the energy sector. I mean, the writing's on the wall. I just don't know how you can step away from it and wait for a pullback, because the flood of money can come in anytime soon, right? So you've seen it in the 2000s. Once it takes off, it's not like, okay, I'll give you a chance here, I'll give you a chance here. It's not like that. It can just be a violent takeoff and just never looks back. So I'm just sitting in there. I'm just waiting for this to happen, because I believe it's inevitable. That's why I'm in it for. And as you said, this, we're talking about not just 100% gains. We're talking about 10x, 15x, 50x, 100x. Who knows? Maybe 200x. So,
Yeah.
I can't be out of this trade. Like I'm sitting tight. I'm sitting tight.
Yeah, I think the energy trade is absolutely massive, and I think it's going to happen with future stuff. And I'm literally looking at companies and buying deposits. I'm not even looking at the management on some of them, not all of them, but on some I am, some I'm not. I'm like, this has a good deposit of rare earth metals. It has high percentage of these rare earths. It will go into production if we want to do renewables and electric vehicles. So I mean,
Yeah.
it's like, just buy the deposit, give it to me. I'll take it for cheap. So, and if you guys want to know that stuff, again, it's the platinum membership down below. If you want to know what I'm buying, you can see my portfolio and you can see the companies I'm buying and what I would be doing real time. So, anything else, Scott?
No, I think it's coming. It's like, I mean, one thing that people need to realize when we talk about, it's gonna take off soon, is like, soon doesn't mean like the next day or anything like that. So let me just go. I just want to go back to demonstrate the false breakout and how long it typically takes to play out as well. So let's just go back to like LEU, because this is what we talked about in our last session. But when we talk about false breakouts, it doesn't happen immediately. I know you say this a lot, Andy, but you always say it takes time. You need to wait. You need to be patient, right? And this is what we mean. So even if there is a false breakout, let's just say that, let's just go back to the previous false breakouts. Here and here, right? So you've had resistance, support, and then this was the false breakout. And then you came up. This is 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks, 7 weeks. And then you had a pretty good solid green bar after 7 weeks, right? This time around as well, you've had a
that entire
breakdown.
move is a big move, though. It went from like $5 or 4 something down there all the way to 18 or 19, 20. Yeah, 20.
19. Yeah, $20, almost $20. Yeah, it's a big move. Yeah, but you just have to be patient. It will start slow and then it will pick up. And this was the false breakout, right? So if you look at the entire move, so this is false break, week 1, week 2, week 3, week 4, week 5, week 6, week 7, week 8, you finally did a retest. Week 8, right? Week 9, and week 10 is the takeoff point.
And
so you're talking about 2.5 months. Yeah.
I hope that does that, because it gives me time to accumulate.
Yeah.
And everyone and their mom's going to be like this. They're going to say, it's not going anywhere. You're not right. This isn't working. It's going too long. And then all of a sudden it will be like, boom, there you go. And look at that long consolidation period from 2021 for what, 6 months or 7 months, 8 months, 9 months,
so
about 9 months or so, 9-10 months.
245 days, 235 weeks. So
but look at the move that happened after. Yeah. That move was massive. It's a huge move.
Yeah,
in a very short period of time. And what this is putting in is a huge fractal of a much bigger move that's coming. So
it's a huge fractal. This is
it's a huge, it's one of the biggest fractals I've ever seen.
It's
it's massive.
You can't even draw this. So, and here's the false break. Sorry, here's the false breakdown. Like we could be waiting here for like 10 weeks. Like if it was to repeat the amount of time it took here. So like these things, like when I talk about false breakout, we're ready to move. Like it takes time. Like it doesn't mean we go up straight away. Like if just look at the charts, I encourage everyone to actually do their own research and due diligence as well. Like, I mean, you just have to, when I talk about false breakdowns, don't just rely on my information that says, oh, we've got a false breakdown. We're going to get a slingshot. because these things, if you just look at the history, slingshots, it takes time. So let me go back to my silver trade back in 2020, because this took time as well. So we had this huge slingshot move, and then you did nothing for 1, 2, 3, 4, 5, 6, 7 weeks. 7 weeks, I was just sitting there, like, just waiting for this to happen. But it takes time. Like 7 weeks doesn't just fly by when you're talking about these type of investments, and you're, hopeful. You're waiting for this to just start skyrocketing. It takes time. Everything takes time. And then you've had 3 solid weeks, and then you've got to wait another month or two, right? 1, 2, 3, 4, 5, 6 weeks, 1.5 months, and then it takes off. So everything takes time. I think it's just so important for everyone to realize that everything in the financial world takes a lot longer than we would like it to take.
Mhm.
It takes time for patterns to develop and finally break out. So yeah, I just want everyone to know that, and just be patient. Just be patient. That's the key word, patience. It will pay off.
Thinking like months and years, not in days or weeks,
Yes,
unfortunately.
100%. 100%.
All right, well, that's all I've got, Scott. I think it was a pretty good session. So,
Yes, I think so.
all right, guys. So I thank Scott for coming on. I really appreciate it. Did you want to share anything else? Any final statements or anything?
Yes.
Okay.
Yes, thank you. Yep. So this is Luke 6:37, and it just says, "Forgive, and you will be forgiven."
And is that directed towards anyone on Twitter?
No, it's
kidding.
for me. For me, it's for me. It's for me. When I read these things, it's a reflection of me. I just make sure that I'm not doing these things. I mean, obviously, I'm a sinner, so I can never get away from it. But at least this reminds me that I need to be forgiving everyone. So, because Jesus has forgiven me for my sins.
All right. So that's all I've got. I think that's everything that Scott has. Thank you, Scott, for coming on. Really appreciate the conversation back and forth. And hopefully you guys are leaving this video a little bit more confident, either in the commodity bull market that's coming, or confident that you're starting to learn more and research more and learn more about the markets to make better investment decisions. So that's all I've got. We'll catch you later, everybody. This is Finding Value.